If you've been following Fired Up Wealth the last couple of years, you've been printing money. But what about the new investor that just got in the market? What stock should you buy? How should you buy in the first place? How do you build a portfolio? What's coming next in 2025? I'm going to answer those questions and share my top 10 holdings in my $2.6 million portfolio. Let's go. I like to build my growth portfolios using 4 primary pillars. The first is going to be ETFs. It's the core, the foundation of your house. We're building a blueprint, and that blueprint is to help you get to your goals. The first $10,000, in my opinion, should be ETFs while you learn about the market before you buy individual stocks. ETFs like the S&P 500, the VU, or the QQQ, that's the NASDAQ 100, or maybe a semiconductor ETF like SOXX or SMH. The final portfolio would have 25% of the allocation into ETFs and try to have several ETFs, generally 3 or 4 ETFs. The second pillar is DGIF. Now, this stands for Dividend Growth Investing for FIRED. Fired Up Wealth is financial independence, retire early with dividends. So we're using growth to outperform the market. We're going to convert those profits into blue chip dividend stocks and live off passive income. Now, the DGIF are going to be total growth stocks, not just focus on the growth of the dividend, but total growth, the growth of the share price, as well as that dividend. Compounding is the 8th wonder of the world, and DGIF stocks shouldn't be slept on. They're huge compounders, especially if you have a lot of time in the market. In this example portfolio, 20% is DGIF stocks, and you can tweak this however you want. Next is going to be growth stocks. Now, there are 3 types of growth stocks. Hyper growth, you think of a company, the spectrum, the life cycle of a company. It starts as spec, goes to hyper growth, then to growth, mature growth, DGIF, DGI, and then income. So growth stocks are going to have that hyper growth, the growth, and mature growth, and you want to have a blend, a balance of those 3. And these are going to help you to outperform the market. When we say the market, the S&P 500, you're building around that core of ETFs and dividend stocks. I want you to focus on quality and secular growth trends. So when you're building your blueprint, you say, hey, this is what the future is going to look like. Which companies can I invest in? They're going to be best of breed and capitalize in these secular trends like cybersecurity, AI, robotics, 5G, crypto, whatever you're into. Every portfolio is going to be different, and it's going to be based on your DNA. 40% in growth stocks. And the last is spec, and this is really important. These are 10x or 0. Literally can give you a 10x return or can go bankrupt and go to 0. So you have to be careful with these because they have high risk reward. In my opinion, you want many versus few. In other words, you don't want just 2 or 3 spec stocks because you're going to be wrong a lot of the time. If Peter Lynch is wrong 40% of the time, he's happy with 60% being right. As a value investor, you're going to be wrong over half the time on these speculative stocks that are burning cash, not profitable. And so if you choose to have this in your portfolio, you want to have a bunch of different stocks. So you want to have 10% max portfolio and no more than 1% for each stock allocated. That means you're going to have less than 1%. So 10 to 20 stocks to fill that 10% of your portfolio. And really that's the hedge risk because you're going to be wrong on these more than you think. Now, as we go through this, I'm going to give more insights like how I might buy a specific stock, some thoughts on 2025 and more. Let's get right into it. I'm going to start with the heaviest weight. We're going to go with the number 1 stock and work our way towards number 10. The heaviest weight, if you've been following me for a while, been in Nvidia since under $4 on my cost basis. It's about 14% of my portfolio right now. We told you in 2022 that it was a must-own stock for any portfolio, any risk tolerance, because of the possibility of AI and data center growth. And now everybody knows that. The question though is what does that cycle look like? What happens as Amazon and Microsoft and others compete against Nvidia? So a couple of thoughts on that. Number 1, as smaller companies, so if you think about that first phase, you think of AI, Gen AI, and that phase 1 infrastructure phase. That CapEx was primarily spent by those mega cap tech companies like Meta and so on. Now, as the prices come down on those older versions, like now we're on Blackwell, every year there's going to be a new version. When you think of the Hopper series, it's going to open up the door to smaller businesses, so small and mid-sized businesses, and not even that, the larger cap businesses that aren't part of the mega cap tech companies, as well as governments and more. But it's going to to create more TAM, or total addressable market, for Nvidia. The other thing that I'm really excited about with Nvidia is automotive. Right now, it's only 2% of revenue, and the growth isn't that stellar right now, but I think there's a lot of runway. When you think of automotive, you think of autonomous driving. I believe that Nvidia will be a major player in this, and there's tons of room for growth. Of course, gaming is really what the company is built on. It'll continue to do fine in that area. And there's also areas like professional visualization and more that Nvidia can grow off of. Now, with all that said, I do believe there will be a cycle. I think the stock is probably going to go higher from here. I told you in the beginning of 2024 it would be over $150 sometime this year, and it did break $150. If I look between now and the next earnings report, I think there's a good chance you see something $160 to $165. Now, earnings are going to have to deliver, and expectations are very high. But if Nvidia keeps delivering and this rollout with Blackwell goes well, there's a chance you could see that stock $200 or more in 2025. So what I own is house shares. I am trimming as it goes higher, but it is still currently 14% of my portfolio. Coming in at number 2, if you follow the channel, you know that I'm also bullish on Snowflake, and it has been a laggard, although I am green on the stock, and it's performed better since its recent earnings report. But we've talked about for many months about the phases of generative AI. We already talked about phase 1 infrastructure with Nvidia. That second phase is going to be software, especially the software that can connect LLMs basically to business data, to enterprise data. We talked about companies like MongoDB, Elastic, Palantir, and Snowflake. Now, I do own Palantir as well. I have been trimming that stock as it goes higher, but number 2 is going to be Snowflake, and it's just under 5% at 4.93% of my portfolio. Again, we've talked about this for months, but recently here, we've had analysts like Dan Ives from Wedbush Securities come out and say, hey, these AI software names are the next phase of AI. Of course, we agree, and this is talking right here about Snowflake and Elastic. Now, Snowflake's already trading at $180 plus a share, and this price target here is 190. You don't buy off price targets, but it is interesting just to see for sentiment. And this is saying that Snowflake will be in the sweet spot to benefit from AI use cases over the next 12 to 18 months. Now, this is consumption based, so it's going to be different than, say, Palantir, which is software as a service. But I believe both those companies will benefit. Of course, the market has really grasped onto Palantir. A lot of us in Discord are buying that stock at $8. Today, it's $72. I posted this recently in the community tab, and it's just to bring you some insight so you have an idea. It's good to look at these numbers that sometimes we just don't think about them. So if you did buy Palantir at, say, $8 in our Discord, a 12x would be a $96 share price. It's trading at $72 or so today. So if you bought it, say, at $71.50, you have to hope and pray that it gets to $100 just for a 40% return. So if Palantir did get to $100, it's a 1,200% gain, a 12x, 1,200% gain for those people buying at $8. Whereas if you bought it at $71.50, you're talking about a 40% gain. And again, this is assuming that you even get to a $100 share price. So the math is absolutely crazy when you think about it. And this deals with FOMO. Just be careful out there. But you can see with Snowflake, the AI data cloud growth. This is April 2020 to October of 2024. That consumption is ramping up. I do think that this stock will do well in 2025, especially as interest rates come down. Number 3, now back in January of 2023, did a top stocks to buy AI stocks for the next decade, top 10. Of course, names like Nvidia, AMD, and Palantir are on that list. If you bought that list of 10 stocks, you absolutely crush it over the last just under 2 years. Well, we said that Amazon and Microsoft should be included on that list because they are the cloud service providers. You think of AWS and Azure, and that both would be important players when you think of AI and the future of AI over the next decade. You already know the story with Microsoft and OpenAI. Microsoft owns 49%, and AI is really fueled off of Azure. This is just from yesterday. Amazon showing us new data centers packed with their own AI chips. So even though Amazon is partnered with Nvidia, and so is Microsoft and really everybody else, Amazon's also going to be challenging Nvidia with its own Trainium chips. This is something we've talked about on the channel before, going back 2 years ago. So AI startup Anthropic as well as Apple are partnered up here with Amazon. So Amazon is my number 3 holding. It's 4.21%. I've been in this stock for many years. Really, everything in my top 10 is going to be house shares. The exception to that really is Snowflake that we just covered. One question I get all the time is, well, yeah, you've owned these stocks for years. Microsoft you bought in 2012. You've had, Nvidia since it was under $4 a share. That's great, Eric, but I'm a new investor. Help me out. What do I do? If you really like a company like Amazon, I told the gang in Discord, it's one of those companies that I think have a lot of irons in the pot. Just had blowout Black Friday sales. Amazon Web Services is huge and it's growing into so many different secular trends. You also have advertising, which has become a huge cash cow for Amazon. When you think of how Amazon grew from an online bookseller, AWS, Amazon Web Services, is really the cash machine that helped fuel that growth to build out the logistics network and so on. But now Amazon really has two cash cows with Amazon Web Services and advertising. And if you think of it, it's a big octopus, almost like its own tech ETF. You're talking about e-commerce, even the possibility when you think of autonomous vehicles. So I've been bullish on Amazon for many years, and I'm still bullish. If I were going to buy a stock on the list of 10 I'm sharing today, it's one that I'd feel comfortable using periodic dollar cost average. That means essentially every paycheck, you just buy a little bit of Amazon. Now, I'm not a financial advisor. I can't tell you what to buy or when to buy or how to buy. I'm telling you, that's what I would do if I didn't already own it. We're going to go rapid fire for the last 7 stocks. Now, I am going to do a video on Patreon here in the next couple weeks. It's going to give you a full breakdown of my entire $2.6 million portfolio. Now, right now, it has over 50 positions. I am making some moves right now. I'm doing some harvesting and so on, but I'm going to bring up to speed. I'm going to give you the most detail that I've ever provided on my portfolio. That's going to be a Patreon exclusive. If you're interested in more discussion and deeper dive and seeing everything that's in the portfolio, you can certainly sign up for Elite, join us, and that video will be coming before the end of this year. I also didn't mention earlier that my number 2 holding actually is cash, around 8%, but I'm just giving you the top 10 stocks, all right? So technically Nvidia is number 1, then cash, then Snowflake, Amazon. The next one in terms of stocks, number 4, is going to be Microsoft. Microsoft is very similar to Amazon, has its hands in lots of different pots, very diversified, like its own tech ETF. The reason I bought it in 2012 is because if anybody could compete with Amazon Web Services, about a year before that, they got into cloud with Azure. And I think there's a huge runway still for Azure when we talk about all these secular growth trends, owning 49% of OpenAI and much, much more. Of course, Activision Blizzard, if you're into gaming, there's just tons of opportunity and segments within Microsoft. Right now, it's about 3.8% of my portfolio. This is all house shares. It's another one, if you want to own this stock, you probably just have to periodically dollar cost average, every 2 weeks, every month, whatever. Number 5, another long-term holding is going to be Apple. Another one that's house shares. Another one you would periodically dollar cost average. Of course, Buffett sold some. If you look at the PE ratio historically, it's as expensive as it's ever been. If you're trying to argue a bull case for that, it's because it's got more into services and recurring revenue. The balance sheet, of course, is stronger than ever. It can basically buy the world with all the cash it has. I'm an Apple guy. I'm in the ecosystem. I've got the iPhone. I'm talking to you on a Mac. I think Apple will do fine long-term. I think the opportunities with Apple, probably healthcare would be a big one. Of course, you know the story. Apple never got into cloud services, which I think they should have. Electric vehicles, that was something they worked on for a while and basically canceled that. It's not nearly as diversified as an Amazon or Microsoft. So if I were picking, just like in my portfolio, I'd have Amazon and Microsoft higher than Apple. The next one on the list, another one we've covered since 2019, bought this stock right after the IPO in 2019. Best of breed cybersecurity. It's going to be CrowdStrike, another one that's house shares. What I do have left, under $100 cost basis. If you like the stock, you got to periodically dollar cost average into it. There was an opportunity here recently when it got down to about $200 a share with the outage. That would have been a good opportunity. If you missed it, you got to periodically dollar cost average. Now, just 1 or 2 videos ago, I just dropped a CrowdStrike update. So check out some old videos that we have. We've got tons of great videos that are still very useful, even though I say old, it might be a couple weeks old or a couple months old. We've got tons of Nvidia and Palantir and Tesla and SoFi and all those different names that a lot of you probably own. The next on the list is going to be Google, Alphabet Google. Now, this one, does have some risk. What does it look like as AI creeps into search? At the same time, you think of Waymo. What's the opportunity with autonomous there, right? There's a lot of moonshots with Alphabet Google, another kind of conglomerate, but it is focused primarily on search, right? And so in my eyes, it's not quite as diversified. Of course, YouTube you're on right now, and Alphabet owns YouTube. Search is at threat. How much of that's baked into the stock price? You know, you tell me. Some of it certainly is. It's not an expensive stock. It's probably the cheapest stock out this entire list. You know, it's $174 right now. This is a 12 months trailing PE ratio 23. One thing to note, this does pay a dividend now. So it's not technically DGIF until it has that 5 years of growth, but it's going to be a DGIF. It's an up and coming DGIF. Apple, of course, is a DGIF. Microsoft is DGIF. Amazon, we talked about earlier, is going to be more of a mature growth company, growth and mature growth. Snowflake's probably in that hyper growth. Some of you, I tell most people just to put it as spec, because if you don't understand, there's a lot of stock-based compensation issues with Snowflake. It's how most people just shouldn't own it. If they do own it, it should be spec. Nvidia does pay a small dividend, but it's so small that some people classify it as DGIF. A lot of people just put it in growth. My 8th largest holding that we've covered a lot on the channel is Tesla. Told you beginning of this year, 175 or less DCA, preference below 150. This stock did get down to 138. If you were buying based on that recommendation, of course, not financial advice, but the recommendation on the YouTube video, you're pretty happy right now with $369. And a lot of these names like Tesla, I have been trimming as it goes higher. I think Tesla, there's a chance it gets to 400. And the way the market is with a lot of FOMO and retail and everything, $420.69 is the limit order that I have to trim some of my Tesla shares. We'll see if it gets there or not. I've got a little bit at 400, another one at 420.69. That's 2.26% of the portfolio. Apple, if I didn't mention, is 3.18. CrowdStrike's 2.79. Google 2.39. Next at 2.2% is going to be Datadog. This is another cloud SaaS name, you know, $55 billion market cap. This is in the profitability, so it's going to show a P ratio of 331. Normally on stocks like this and Palantir and CrowdStrike, you're going to use that EV/NCM revenue. Palantir, of course, is in its own stratosphere. It's trading 300% premium to a stock like a CrowdStrike. Datadog is not a cheap stock. You can see 52-week high 166, 52-week low 98. Most people in Discord bought this stock in the 80s, some people in the 90s, but nobody's buying it at 163. If you really like the stock on something like this, instead of periodically dollar cost averaging, you might just have to put it on your watch list and wait for a pullback. This is the type of stock, if it misses earning, you know, it drops 20%, 30% on earnings miss. That's probably what I'd do with Datadog versus that periodic dollar cost average. And another stock that we've covered extensively, 2.16% of the portfolio, and the 10th largest position is going to be AMD. Right now, the TTM PE ratio is 126. Still not cheap. When this stock got up to $200, I actually trimmed some. People said I was crazy. It's been in a funk. If you look at year to date, since it kind of peaked out here in that $210 range in March, you know, way at the beginning of the year, you can see that we did have another spike at 183, but it's been trading lower than that March level pretty much, well, all the year, right? So 227 is that 52-week high, 116, 52-week low. I really prefer this stock under 100. You might not get it. 125 would be kind of the next level. This is another one you either have to decide if you want to periodically dollar cost average, or you wait for a miss, an earnings miss or something like that, and you buy it on a sell-off. It's going to depend on how you build your blueprint, what you consider a core. If you want this as 5% of your portfolio in a core, well, you're going to probably buy it every paycheck and periodically dollar cost average. Again, if you want to see the entire breakdown of the $2.6 million portfolio, the video is not ready quite yet, but it will be coming soon. Head to patreon.com/firedupwealth. If you're new here, subscribe. I'm trying to help you be a better investor by bringing content like this to you every single week. And if you want to return the favor, smash that like button, drop me a comment. Have a great rest of your day. Take care.